work. So if you look at the car or the home, who won in this investment? Well, we got the house, sure, but we paid out and shelled a tremendous amount of money. But the profit from this house actually went to the banking institution. So they're the ones that they were not at risk. They don't have to pay taxes on the house if they sell it. They don't have to pay the upkeep on it. But they profited well over $500,000. So if we can change the situation and get rid of the banker, what if from this point on we could always have the concept that we pay ourselves? And so we take the loan out from ourselves on every asset that we do, and we keep the full money. Even if we sell the house, we get a little bit of profit and pay some taxes on it, still it doesn't matter. So the idea of setting up your own family bank, or the concept of your own family bank and eliminating the banker, is a fundamental concept that we've been teaching our business owners and our clients for many, many, many years. And so if we then say, okay, we can look at an example of buying a car, we can look at an example of buying a house, but what if we're going to retire off this money? Well, we all know that when we retire, we still expect to pay taxes. And taxes can be a huge burden for a lot of us. Taxes can be as much as 10, 20, 30, 40% of our total amount of money that we have in retirement. And in fact, we can have pension plans, we can have 401k plans, and the problem is all of those things are taxable, and we also expect to earn Social Security benefits. Well, when we turn 62 years old, we are in a position where we can start to receive Social Security benefits. But if we receive Social Security benefits and money from pension plans and IRAs, all that money goes into what is called provisional income, and that provisional income now means that if we are single, filing a single tax return, and we earn a certain amount, and that amount is just a little over $20,000, now all of a sudden our Social Security benefits are taxed. Well, there's another way. We can actually never run out of money, and we can pay no taxes. Now, here's an example that I want to show you again just to see the concept. The concept is we buy and set up a family bank. Now, the family bank is really not a physical institution. It's not a physical building. What it really is it's a concept where we buy a life insurance policy that is comprised of two components, a face amount and a cash value. Now, here in this example, we have a 41-year-old doctor who buys a $1 million amount of insurance. He puts $3,000 per month into this account. His goal is to retire to age 65. Now, he saves $36,000 per year for 23 years. So he's going to save a total of $828,000. But in this concept, watch how powerful this is. At age 66, he will begin to withdraw $365,000 tax-free dollars per year, and he can still receive 100% of his Social Security benefits 100% tax-free. On the other hand, if he would have contributed this $3,000 to a 401k plan, he would not ever be able to pull out this amount of money. In fact, he might only be able to pull out about maybe $30,000, $40,000, $50,000, $60,000 per year, and he would have to pay taxes on it, and his Social Security benefits would be penalized. So if that doctor had put money into the qualified plan, what would be the difference? How long would the money last? And how long will his money last inside our concept called the family bank? Well, the answer is forever. So let's look at a specific numbers here. How this works is we buy the policy. We qualify for a certain amount of life insurance. We have to qualify through this by going through the little physical to see if our health warrants that amount. The insurance company will rate us, and then we pay for the cost of insurance. Now, the cost of insurance is based upon how old you are, your health status when you buy the policy. The doctor was going to put in $3,000 per month or $36,000 per year. He was going to do this for a certain number of years. Now we can see that when he puts the money into the policy, that the cost of insurance is taken out of our account and we have a cash value. This cash value grows just like it grows inside of our account. The rate of return that we earn is going to be based upon whatever the S&P 500 market is going to be, or a combination of a fixed account earning 5.75%. Most of our clients over the last 10 years, 20 years has averaged about an 8.5% rate of return. So in many of our calculations, we just used a fixed 8% rate of return to represent that. But we can see that as time goes on, the doctor stops contributing to the account. His total account value has been growing in this account 100% tax-free because it's protected by a life insurance policy, but now the concept of the family bank comes into play. He starts to take out a loan for over $200 or $360,000. But I want you to notice something. Even though he's taking out a loan, he's taking out a loan that is collateralized against the death benefit. Now we can see here that the cash value continues to increase. And the reason why this increases is because in the concept of the family bank, we want to take out a loan but have this collateralized by the insurance company, meaning we do not want to liquidate our own funds. We want the insurance company to actually write us a check for $369,000 out of their coffers. But they are willing to do this if we collateralize this loan against the death benefit. So if this individual, say, lived until 80 years old, they would have contributed approximately $800,000, but they would have withdrew $369,000 per year for, what is this time period? 15 years. And during that time period, if they would have passed away, they still leave a significant estate to their beneficiaries, 100% income and estate tax-free to the beneficiaries. So if we were to look at another example where this particular doctor was going to contribute $36,000 per year, but every 6 years he wants to buy a $50,000 car and stop the contributions for a year, his situation would be he puts in the money's growing into the account, he stops the contribution in the 7th years, takes out a loan from himself, from his own bank, from his own policy. You could see that the value of the account does not decrease, but it doesn't grow as much because we didn't make the $36,000 contribution in there. But he buys the car 100% tax-free, 100% debt-free, and the account continues to grow. Every 6 years, he does exactly the same thing. So he's actually purchased 3 cars in this page here alone and still has a couple $1,000,000 at retirement. And then he starts to take out a loan, and in this case it's $339,000, 100% tax-free for the rest of his life. So that is the concept of the family bank. So if you were to just look at every 7-year time period by itself, we put it in for 6 years, take it out. Now there's really no limit to when you start to take money out, except for you have to wait at least 1 year. And the IRS determines how much money we can put into this. So the amounts that we contribute or set up for each doctor are really based upon their age and based upon their health status. And so we can see that in this example, this individual, obviously